Hello, my name is Michael Levy. I am the co-director of the PASS program. What I'd like to do today is show you a short excerpt from the Core 1 component of our Challenge Exam course. During this course, we would review the various accounting topics that you need to know for the Core 1 exam. Typically, we would spend time for each topic on a detailed lecture in which we review the technical material. We would then take up some multiple choice questions. Let me show you a short excerpt dealing specifically with one of the topics you're responsible for, and that is intangible assets. I'll first give you just a little 2-minute excerpt from the lecture. The actual lecture on this topic is about 45 minutes, but I'll just spend a couple of minutes just giving you a taste. And then I'll give you a short excerpt from the take-up of the multiple choice questions. Intangible assets. Let's start with an introduction. This topic is covered under IFRS, under IAS 38, intangible assets. It's covered under Canadian GAAP, or what we call ASPE, under Handbook Section 3064, Goodwill and Intangibles. Now, IFRS and ASPE are very similar when it comes to this topic, but there are some significant differences you need to be aware of. So what I'm going to do is I'm going to base my presentation on IFRS, but at the end of the lecture, I'll go over the significant differences between ASPE and IFRS, so that you're familiar with both GAPs by the time we finish. Because of course, either GAP could be tested on the Core 1 exam. In order to recognize an intangible asset, number one, we need to demonstrate that the asset meets the definition of an intangible asset. We also need to meet the standard recognition criteria that need to be met to recognize any asset. Let's start off with meeting the definition. In order to meet the definition of an intangible, certain criteria need to be met. An intangible asset is an identifiable non-monetary asset without physical substance. So the first criterion is identifiability. Also, the entity must have control of the asset. That's the second criterion, control. The final criterion is there must exist a future economic benefit. Let's look at each of these criteria in more detail. What do we mean by identifiability? By identifiability, we mean that we can separate the asset from goodwill. Separating the asset from goodwill can be achieved in one of two ways, if we meet one of these two criteria. The first criterion is we can actually sell this intangible. So for example, if we have a customer list, notwithstanding privacy legislation, we may be able to sell this customer list. It can be separated from the company. Therefore, this customer list would be treated as an intangible rather than being buried in goodwill. Alternatively, it arises from a legal right. Examples of legal rights would be patents, licenses, maybe a favorable lease. So as long as we meet one of these two criteria, as long as we can separate it from the company by selling or renting it, or it arises from a legal right, we would set the asset up as an intangible rather than treating it as goodwill. What I'd like to do now is skip through some of the lecture and take a quick look at a multiple choice question. Typically, I would give students time in each class to work on multiple choice questions, and then we would take it up together. Here's an example of a multiple choice question on intangibles. Heinz Inc. is involved in the development project aimed at developing a new technology for producing widgets. During 2012, the company incurred $1 million of development costs. Although the company felt that it had met some of the criteria necessary to recognize to expense the full amount in 2012. We know that one of the criteria that a company needs to meet in order to set up an intangible is they need to have sufficient resources to complete the intangible. So the company would have been correct in expensing the full amount in 2012, given that they did not have sufficient resources. In 2013, the company incurred another $500,000 of development costs and recognized an intangible asset arising from development. By 2013, the company had managed to obtain sufficient funds to complete the project. So in 2013, it would have made sense to capitalize the intangible, as now they do have sufficient resources. Now, in 2014, the company discovered that the scientists working on the project had falsified some data, and that in fact, contrary to what they had believed to be the case, the project was not technically feasible. So let's see what we're being asked to do. Assuming the development costs have been accounted for correctly in 012 and 013, which of the following correctly describes the treatment of the development cost in the 014 financial statement? So, as we mentioned a moment ago, it would have been perfectly appropriate in 2013 to capitalize the development cost as we now had sufficient resources. The question is, what do we do in 014 when we discover that information was falsified? So, let's take a look at what our options are. We've got four options, A, B, C, and D. Which one best describes the correct treatment? I would have chosen B. The 2014 income statement should reflect no write-off. Rather, the prior year's statement would be adjusted retroactively to reflect the write-off. The reason for this is quite simple. The company did the correct thing in 013 by capitalizing based on the information available. At that point, they didn't know that anything had been falsified. In 014, when they discovered the falsification of information, at that point, we have what's called an accounting error. How do we correct that error? We correct the error retroactively or retrospectively. So what we should be doing in 2014 is not expensing anything because we're correcting an error. We, in error, had capitalized the intangible in 2013 based on incorrect information. Therefore, rather than expensing any amount in 014, we retrospectively restate the 013 financial statements to write off the $500,000. I hope you found this excerpt useful. Please feel free to contact us. If you have any questions, you'll find our contact information on our website.